Hello, my name is Eddie Tofbig. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. The key move here in recent times, as I said 2 weeks ago, has been the move back down below the very super significant 50% absolute Fibonacci line at 218 3/4. This has now quashed the earlier ideas of a handle, a specific pattern addition to a rounded bottom, and also the idea of a bull flag come bullish halfway hesitation pattern formed from about mid-February to the end of May. Now, unlike some of the other grain markets, we do not really have a double top pattern here, lopsided or otherwise, in the recent past. What we do have, or should I say did have, was a mid-February to late June uptrend, currently broken at 214 even, that looked like it might have been part of a very big February to late June bull channel. However, this bull channel is no longer valid, though I do note how the market has been trying very recently to run along the underside of the broken lower bull channel line. We nevertheless have seen some stalling when prices drop down to the 208 to 212 area, thus giving the impression of a possible hesitation, even a halfway hesitation pattern being constructed. If this hesitation were to truly become part of a corrective hesitation in a large mid-May to date action, then we would have possibilities of prices initially reaching 204 1/4, which is not too far and a little under the rising mauve medium moving average, plus the lows of May and April around the 204 zone. Something we have already done, as well as the congestion seen between December 2018 to February 2019, between 204 to 208. So perhaps this might be a more substantial as support as it might seem at first glance. Notwithstanding this somewhat ancient support, the secondary harder possibility, still a possibility, is down at 194 even zone, which, much as I said in Kansas City wheat, this continues to be an early speculation on my part. It may not happen, but I'd rather get out there now, look foolish, look a bigger fool if prices start motoring lower in between my commentaries. I'm not happy about calling this pattern triggered as yet, and will thus hold off clarifying any targets below for now. Minneapolis wheat. On the lookout for what would be the next main pattern here, and well, it seems to have started settling 3 weeks ago on an old pattern, but with a new twist. Prices dropped down to the broken, tripled up bull channel, currently 646 3/4 to 666 1/4, but with the added twist of the rising mauve medium moving average running through it at the time, or still running through it now at the moment. I suppose that congestion 651 even, as well as the congestion 650 even to 651 3/4, around the August 2018 high at 650 even and the April 2024 low at 634 3/4. Now, prices settled on and around all these for a little while and even created a weekly key reversal up last week. However, as I said earlier in my Kansas City week commentary, and I quote, and this applies here, I was suspicious of it because I had also detailed what I thought would be some forceful patterns in operation, especially on the downside. You see this move lower, much as in Chicago, we opened up the idea for a possible mid-April to date double top pattern. But I have to admit it is one very, very lopsided double top. End of quote. This is exactly the same situation here in Minneapolis wheat, but a little more advanced. I spoke about this 3 weeks ago when I said, and I quote, the importance of this 50% Fibonacci line, so this is the 50% Fibonacci line of the May to August 2024 move at 669.5. The importance of this 50% Fibonacci line is also the base of a mid-April to date double top, Adam and Eve type. And the break below the 50% Fibonacci line is the follow-on move lower. Thus, for this pattern, we have a primary target X2 down in the 635 1/4 zone, right on the April 24 low, for a secondary hard to achieve target X3 down in the 606 zone, right on the April 21 low. Right now, the market has been halted by the slowly rising mauve medium moving average, currently at 651 even, and I'll be very interested to see if the market can make that short leap lower to the April 24 low. And that's the end of the quite extensive quote. Last week we saw that leap lower to the April 24 low, but this week we have gone even further. Through target X2 at 635.25 and down to the secondary, harder to reach target X3 down at the 606 zone, and below the slowly rising gold long moving average, currently at 615.5, as well as the October 2018 high at 611, to land on the April 21 low at 606. And this is where I will deal with that hesitation seen earlier over most of June. It was, as I said 2 weeks ago, and I quote, because if it is a corrective hesitation, then we might possibly have a larger move lower for an end of May to date action, or of initially a possible move down to around the 618.25 area, and a secondary harder possibility of a move down to around the 516.9.5 area. These are not targets yet, just possibilities, and will only happen if what we see this past week or so is a corrective hesitation. However, much as I said in Kansas City wheat and in Paris milling wheat, this is early speculation on my part, and it may not happen, but I'd rather get it out there now and look foolish than look a bigger fool if prices start motoring lower in between my commentaries. End of quote. Well, the initial possibility around the 618.25 area has easily been reached, leaving us with the secondary harder to reach possibility, now a secondary target X4 down in the 516.9.5 area. Now, I have to say this is a big drop to swallow, given the congestion we have in the market prior to the US-Iran war between about 595 even all the way down to about 570 even. But for now, I will still label it and lay out there as a possible much harder to reach target. A quick final thought. I've looked at the idea of the whole 2026 action being a possible inverted ascending scallop pattern, but I've rejected it right now. London UK feed wheat. There are two key long-term patterns here to bear in mind, with a common neckline extension which is highlighted in dark blue on my daily chart, and that's currently at 169.30. Remember that level, 169.30. I'll shortly detail these patterns, but first I'd like to discuss the recent action over late April, May and now June. First off, we are still within the purple end of June to late October 2025 bullish shift pitchfork, in between the purple middle tie and above, currently 185.30, and the purple lower time below, currently 163.75. However, the main recent pattern we created had been the late April to late May head and shoulders top. We broke down through the neckline of this pattern 4 weeks ago and reached down to both primary and harder to reach secondary targets easily enough. So we now need to discuss whether the action over the start of June is forming a possible bearish halfway hesitation or not. Well, it is still too early to say, but if it is, and it may happen in between my commentaries, then we'd have initial possibility down in the 170 even zone, close to that key neckline extension, and the slowly rising gold long moving average, currently 169.43, plus a harder to reach secondary possibility, not a target, possibility, down in the 162 even zone, where we have the congestion from autumn and winter 2025 and spring this year. These are not targets yet, just possibilities, and will only happen if what we see developing throughout June becomes a corrective hesitation. However, much as I said in Kansas City wheat and Paris milling wheat, and also in Minneapolis wheat, this is early speculation on my part, and it may not happen, but I'd rather get it out there now and look foolish than look a bigger fool if prices start motoring lower in between my commentaries. So, all this in mind, let me now discuss the longer term points once again. The same points I've been discussing here for a year and a half, as some of them were things that I noted back in my annual commentary back in January 2025. To see these, it is best if we switch from to my longer term monthly charts. Firstly, I saw back then the potential for a very large May 23 to April 25 bearish cat's ears pattern. And that's akin to a double top pattern, but formed after a big drop, such as the fall we had in early 2023. As well as this, we had an even longer term second pattern, August 20 to April 25, a very large head and shoulders top pattern. These two super long term patterns both rely on one single feature, and that is their common neckline, highlighted in purple on my monthly chart, currently 169.30, same as on the daily chart I just spoke about. Now for the bearish cat's ears pattern, its time has come and gone, but we still can look at the longer term head and shoulders top pattern as still a live pattern, with primary target X5 down in the 64.20 zone, close to where sits the oldest uptrend I have on any of my 250 or so charts. The 1975 today, yes, it's a half-century old uptrend, and that's currently at 66.30. I'm not even going to give you my secondary hard to achieve target for this pattern, as it is below zero. Please, please, please bear in mind that these are very long-term targets, stretching possibly over many years, but they are still targets below for these patterns above. Now, that all being said, July 2025 that is, with changeover through a major spanner in the works for such a long-term patterns. The reactionary immediate countering monthly key reversal up for July last year went back above the purple neckline, but stopped at the 50% absolute Fibonacci line at 180.5, just under the bright green 2023 today upper bear channel line, which is currently 169.10. The question this posed, and it's a longer term question, is whether July 25 was just a reactionary single month move higher or the beginning of something else. I have said for about 3 months now that these two bearish patterns will not be the way forward, and that what we have is a base for a move higher. March provided a single monthly close barely over the bright green upper bear channel line. April did much better with a clean close higher. However, I said repeatedly I would like to see a minimum of at least one more month, ideally the close of May, over the bright green upper bear channel line to verify this move higher, and ideally over the 50% absolute Fibonacci line at 180.5. Well, we saw that strong close for May, but the pattern for May was a bearish one, a shooting star pattern, type 1 bearish, and June has already started gapping lower for follow-on move down and looking like a bearish opening black Mariposa at the moment. This now throws the idea of a reactionary move back up into one that is heading back down, as prices seem set to move back down to the important common purple neckline once more. And it does raise the question whether the whole 2023 today action could be the start of yet another pattern, perhaps an opportunity for a very large reverse head and shoulders pattern. So watch this space, as time will tell. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.